Mr. Chairman, I'll make this brief. I was thinking about the comments that that Ms. Waters made regarding the PIMCO chair, reflecting his comments that about increasing the down payment on houses might be burdensome for home buyers. But isn't it true that it would also help to, if you will, rationalize home prices? I'd appreciate the panel's assessment of that.
Yes, it largely would. I mean, I do think that we need to get back to a point where housing prices reflect fundamentals rather than, availability of credit driving prices necessarily. There should be credit there. I do want to note as well, there was an earlier discussion about very large down payments in the 20s, and I will note that the homeownership rate for working males 55 to 64 in 1920 was 66%. So in no way was in the 20s homeownership limited only to the wealthy. That's false.
Congressman, I'd say I have spent a lot of time around bond markets in my career, and the head of PIMCO's comments have been widely cited. I never take seriously what bond traders say. When it comes to down payments, there's no doubt that, and this is just an unquestionable regularity of housing finance, that size of down payments, or inversely the extent of the loan-to-value ratio, is one of the most reliable indicators of credit performance, either good or bad.
I think that it is true that down payment is a relevant factor, but I think we overemphasize it in the conversation. In the late 1990s, there was a great deal of very positive experimentation that was going on, demonstrating positive ways to mitigate the risk of low down payment lending. And all of those good practices were wiped out by the abusive practices in the subprime market. And there are enormous disparities of wealth in our society, and communities with low home ownership rates have other social costs. So if we go to a system where we mandate very high down payments, there'll be consequences that I think we'll all be very sorry to see. So we need to make sure that there are ways to mitigate risk, but down payment should not be our only measure.
Is it fair to ask on a very fundamental level whether or not all that these GSEs have done and all that the federal intervention in the housing and mortgage markets has done, is it fair to conclude that those most vulnerable have actually benefited from these interventions? Because certainly the state of our economy would suggest otherwise.
And I would say in large part no. And if you just look at the waves of foreclosures that have basically been besieging the United States over the past several years, any gains that were established turned out to be faulty and have been wiped away. And in large part, there are a number of individuals who seemingly thought that we were helping that are now worse off than when we started.
If I could make a comment, I've worked on housing policy, mortgage finance policy for a very long time, and one of the things that's constantly puzzled me is that proposals that have the aim of running up housing prices are presented as enhancing affordability. That kind of confuses me. Usually, that's a transfer to the seller. I look at it as housing is a basic necessity of life. Everybody needs shelter, and when housing becomes more affordable, that is when prices come down, I think that's a great thing. Now, apparently, the impact of that certainly helps the poor, hurts maybe the middle class and the rich, but that's a policy outcome I can live with.
I think it's important as we look backwards, though, not to conflate the role that the GSEs played in the housing market with the consequence of the subprime crises that we had. The reality is, if you look at the Financial Crisis Inquiry Commission report and others, the preponderance of the evidence here is that there was an intervening factor. There was this unregulated market, the shadow banking that was accelerated with the Wall Street inventions. The result of that was chasing horrible loans, and it is that lending practices and not the lending practices of the GSEs. They reacted to those. They joined in the party. They've cost a significant amount of money to the taxpayers. I have no book to protect their record. But I think we should be very careful here not to conflate the role the GSEs played in the housing market prior to the year 2000 with the consequences of the subprime crisis.
May I have 30 more seconds, Mr. Chairman?
I'm sorry, no,
Oh.
your time has expired.
Well, thank you.
Your colleague from New York is up next. If he wants to yield you.
I will yield my time.
Oh, thank you, Mr. Grimm. I would simply submit to you that there were, as we all know, dissenting opinions regarding that financial inquiry commission report, and the clear message that someone like me would take from it is that it is, in fact, the implicit federal guarantee, indemnification of bad risk, that created the impetus for all of these risky investments. Thank you.